This Spotlight on Income Planning is sponsored by American Retirement Systems, providing competitive solutions for agents and advisors. For more information, please visit AmericanRetirementSystems.com. Although most Americans don't trust the financial services industry, the majority are confident in their own planner, according to the most recent First Command Financial Behavior Index. 90% of survey respondents said they trust their own planner, most often due to a personal relationship and good service. Among respondents who worked with financial planners, just 27% said they trust the financial services industry. Of those surveyed who don't work with a financial planner, 46% said they trust planners in general, and only 17% said they trusted the financial industry. Approximately one-third of the 1,000 U.S. consumers surveyed said they currently have a financial planner, but 16% of those without a planner said they are likely to begin working with one this year. Additionally, 43% of middle-income respondents who currently work with a financial planner said they chose their planner based on a recommendation. Asset managers' net margins rose to 23.4% during the fourth quarter from 21.1% during the third quarter, according to Cassina. Margins are now back to levels seen before the credit crisis of 2008. According to Eric Doherty, Director of Research and Principal at Cassina, quote, "Firms are above pre-crisis margin levels, supported by a combination of surging markets and some belt tightening. From an operational perspective, many firms are actually in a better position than they were in 2007 and 2008. Margins are back to attractive levels, but the market is still substantially below its high," unquote. The recovery has been fueled by improvements in the markets and more frugal strategies from asset managers, Cassina said. Doherty added that fund firms must ensure that costs remain low as they continue to juggle investments in technology and innovation. Meanwhile, firms must also focus on their core competencies, use the internet to distribute cost effectively, maintain strong national accounts teams, and target the most profitable market segments and advisors with their distribution efforts, Cassina said. A growing number of financial advisors are fleeing traditional wirehouses, bank brokerages, and independent broker-dealers in favor of hybrid models in which they can serve as both an RIA advisor and a registered rep, according to a report released last week by Charles Schwab. The most recent Schwab Market Knowledge Tools report found that the percentage of dual-registered advisors is expected to rise from 4.2% in 2009 to more than 7.7% in 2014. Over the same time period, the percentage working at RIA-only shops will increase from 5.9% to 10.1%. The percentage of advisors and reps working at wirehouses, IBDs, and insurance and bank broker-dealers is likely to diminish slightly or remain flat by 2014. The report found that consolidation in the bank and brokerage industry has led to increased migration in recent years, with the number of duly registered hybrid firms growing at a compound annual growth rate of 14.7% between 2004 and 2009. The trend is due to a combination of tough economic conditions, a cultural shift, and advisors' needs to expand their revenue opportunities by offering a wider variety of products and services, Schwab said. According to Nick Georges, Vice President of Schwab Advisor Services, quote, "Ultimately, the decision to adopt a hybrid practice model and determine which flavor is the right one comes down to an advisor's business philosophy and objectives. Once things like investment approach and mix of investments, desired revenue model, and ideal client profile are in place, an advisor is in a good position to determine the right plan to take," unquote. For more industry spotlights, visit producersweb.com.